Have you ever heard about national income? No? So, in this video, we are gonna learn about national income. What is national income? National income is all income received by all members of society or all family household, or you can say RTK, in a country for a certain period of time, usually within 1 year. National income can also be interpreted as a result of national production, which means the value of the production results produced by all members of a country's society within a certain time, usually 1 year. National income is an indicator to measure the development of the level of development and welfare in a country from time to time.
Factors affecting national income. Number 1. Quality of human resource. If in a country the human resources are of high quality, namely having good education, work ethic, skills, and technological abilities, the country's national income will also be high, because if the human resources are still of low quality, then the state cannot manage natural resources effectively, so that the country will continue to be shadowed by poverty. And number 2, natural resources. A country that has a lot of natural resources and use them properly will have a high national income. Even from natural resources that are well managed, the state can meet the needs of its citizens without any effort. Examples of such countries are oil-producing countries such as Qatar and the Emirates Arab Union. They don't even impose tax on their citizens. Number 3, capital. If a country has sufficient capital to process available natural resources, of course the country's national income will increase. Conversely, if a country lacks capital, the country's national income is not optimal. In general, if a country lacks capital, both capital goods such as machinery and money capital, then that country will invite foreign investors to invest, usually in the form of establishing companies. However, if a country has a lot of capital, especially developed country, then that country will invest part of its capital in other countries it wants. Number 4, security stability. Poor security stability will greatly affect the achievement of a country's national income. For example, if there are frequent riots, violent demonstrations, bomb explosions, terrorism, tribal wars, and separatist movements, it will result in a reduction in the achievement of national income. Conversely, if the stability and security are good, it will certainly encourage economic activity, so that the amount of national income will increase. Number 5, government policy. Government policies greatly influence the achievement of national income. If a country has a government that is clean, authoritative, and qualified, the government of that country will certainly make the right policies. But in the political and economic fields, the right policies and accompanied by responsible implementation will certainly affect the increase in national income. Number 6, geographical and geological condition. A country with a certain geographical and geological location is at risk of experiencing natural disasters that recur every year. Natural disasters such as earthquakes, typhoons, and floods, which occur rapidly, will damage existing facilities and infrastructure. This damage certainly has an impact on reducing the achievement of national income. On the other hand, a country that is never hit by natural disaster will not experience the damage which result in a reduction in national income. And the last number is consumption, savings, and investment. As we know, based on the special expenditure approach For a simple closed economy, that is, an economy that does not involve foreign relations and does not involve government activities, national income only consists of consumption and savings. Benefits of national income. Benefits of national income is to guide the government in making national policies, to find out the economic structure of a country, to find out the economic progress from year to year, to determine the level of community prosperity, to compare economies between countries in the world, and the last benefit is to determine the use of community income.
What is gross national product? Gross national product is the total monetary value of products and services produced by residents of a country, regardless of the location of the production. The production location may be in the country or outside the country. So, for example, gross national product takes into account your output and the output of your friends or relatives working abroad. Why gross national product is important? Gross national product is important because you can use to measure the welfare, standard of living, and income of a country. If there are many citizens who work or national companies operating abroad and a significant portion of the output, then gross national product may be an important indicator for you to look at. But it has limitations. Unlike the gross domestic product or gross national product, change might not spread to other economic variables. Say, the output of Indonesia national company operating abroad has increased significantly. It may not have major impact on employment or domestic income. The company will recruit local workers in the order on country, not domestic workers, such as you or your colleges. Because of this, the economy and investor are usually more concerned with United Nations than gross domestic. First, provides a more accurate picture of the economic health of a country, including in relation to indicators such as inflation, unemployment, investment, interest rate, monetary policy, and fiscal policy.
Net National Product, or ENNP. Net National Product is the total amount of gross national product that is reduced by depreciation of capital goods. This depreciation is the replacement of capital goods for equipment used in production activities. In the form of an estimate so that errors can occur even in relatively small manner. NNP is GNP minus depreciation or depreciation of capital goods. Net national income. Net national income is an income calculated based on the amount of remuneration received from the people who own the production factors. Net national income is NNP minus indirect taxes. Individual income.
Personal income is a regular compensation that an individual receives in the form of salary, wages, tips, rents, and or other sources. An individual earns personal income in order to pay for personal expenses, such as one's mortgage, debt service, groceries, and so forth. Personal income is necessary for an economy to function. Most governments tax personal income differently from both corporate income and investment income. Personal income is used in calculating adjusted gross income (AGI), which is important to individuals for income tax purposes. It is also an essential measure to investors because it serves as an indicator of future demands for both goods and services in the market. If personal income is high, there could be more money spent in the economy, indicating a future business boom. Disposable income, also known as disposable personal income (DPI), is the amount of money that households have available for spending and saving after income taxes have been accounted for. Disposable personal income is often monitored as one of the many key economic indicators used to gauge the overall state of the economy. Disposable income can be calculated as personal income minus personal current taxes. The amount of disposable income for the resident of a country is closely followed by economists, as is the level of consumer spending, which depends in a part on disposable income.
State income can be calculated using three approaches. The income approach by adding up all income, wages, rent, interest, and profit received by consumption household in a country during a certain period in return for the production factors given to the company. The production approach by adding up the value of all products produced by a country from the industrial, agricultural, extractive, service, and commercial sectors during a certain period. The value of product calculated using this approach is the value of service and finished goods, except raw material or semi-finished goods. Expenditure approach by calculating the total expenditure to buy goods and services produced in a country during a certain period. The calculation with this approach is carried out by calculating the expenditure made by four actors of the country economic activities, namely household, consumption, government as a government, investment expenditure as an investment, and the difference between the value of export minus imports.